if you go to growth equity or PE, you're probably making between 250 to 400K. Again, it depends on the size of the fund that you go to, right? Like when you're looking at the 400K, you're looking at places like Apollo, or even like 300 plus K. You're looking at like the mega funds, okay? Like the Blackstone, KKR, TPGs of the world, right? Hey, what's up everyone? Sam here at Wall Street Mastermind. Wanted to talk to you guys today about the different buy-side exit opportunities that you have coming out of investment banking, okay? This is a question that I've been getting a lot. Just people want to know, hey, I got into banking, I know I don't want to stay in banking forever, and so I'm looking ahead to the exit opportunities, but I'm not really sure, between the most popular options, which are, venture capital, private equity, or hedge funds, which one is the best one, right? And so before I dive into any of this, I just want to preface it by saying there is no best one, right? This is somewhat subjective. If you ask different people, they're going to tell you different things. And by the way, everyone you talk to, their opinion is always going to be influenced by their own personal experience, whether it's their own personal experience or that of the people around them that they know who have gone through these fields, right? And that's no different today. Like, obviously, I have my own personal opinion. Personally, I went into private equity after banking, after a lot of thought, and I'll explain what that is in a second here. But I have also had a lot of friends that have gone through venture capital, especially since I live out here in the Bay Area in Silicon Valley, right? And I also have had friends that have gone through the hedge fund route, right? And so I've kind of seen all of these different paths. So either way, I just want to say there's no right or wrong answer here. Ultimately, you got to do what you think is best for you. But I'm going to walk you through some of the primary differences. Okay, so anytime I'm thinking about my career path or what I want to do for my next job, there are probably four major areas that I'm thinking about in no particular order, right? It's compensation, which is obviously very important. How much am I getting paid for my work? Secondly, work-life balance, or in other words, how many hours am I going to be working? The third thing is exit opportunity. And then the fourth thing is, learning, which is also ties into roles and responsibility. Like, what am I going to be working on and what am I going to learn from this job? What kind of transferable skill sets is it going to give me, right? Now, if we look at these four areas, and by the way, again, I said in no particular order, which means depending on who you are, you might value each of these criteria differently. Like, some people just say, hey, I just want the highest paying job. I don't really care about anything else. That's totally cool too, right? Other people, I say, hey, work-life balance is really important to me, and there's nothing wrong with that, right? So you have to decide which of these factors is most important to you. There is no perfect job that is just like the best across the board in every single way, okay? Now, let's go one by one through these. This table should be pretty easy to understand and self-explanatory, but on the compensation front, and by the way, the pay that I've listed here, this is like the entry-level pay, or by entry-level, I mean like this is what you would typically be able to make if you were coming into one of these buy-side jobs straight out of 2 years of banking. Okay, so you're coming in as a VC associate or PE associate, pre-MBA, right? Or for a hedge fund, like maybe you're going in, at the most junior level, right, as a hedge fund analyst. And so, as you can see here, typically, look, VC is going to be on the lower end of the scale here relative to PE and hedge fund. You're probably making on average $150,000 to $200,000 depending on the size of the fund, and I would say probably closer to $150,000 than the $200,000. Okay, in private equity, and by the way, we lump growth equity in here because growth equity is kind of like a hybrid between VC and PE, but I would say it's a little bit closer to private equity from a recruiting standpoint and in terms of skill set. And so I lumped it in with private equity. Now, if you go to growth equity or PE, you're probably making between 250 to 400K. Again, it depends on the size of the fund that you go to, right? Like when you're looking at the 400K, you're looking at places like Apollo, or even like 300 plus K. You're looking at like the mega funds, okay? Like the Blackstone, KKR, TPGs of the world, right? If you're looking at, middle market, then you're probably looking at closer to 200 to 300K or sometimes 250 to 300K. And if you go below that to like the lower middle market funds, then it could be even lower, right? And so both in VC and in PE, like how much you get paid is very much correlated to the size of the fund that you work at. Okay, so that's the most important thing to keep in mind. In terms of hedge funds, you can see there's a much wider variance here. Like it could be as low as 150 all the way up to 600, maybe even more. Okay, and that's because in hedge fund, your performance is tied a lot more to how well the fund did in any given year, and then also how well did you do in any given year, right? In the investments that you worked on. And so if you just absolutely crush it, you could have a really, really great year and get paid a lot of money, right? But at the same time, like if you don't do well, or if your fund doesn't do well, sometimes you'll get zero, like no bonus, right? In which case, like the 150K, that's just your base salary, right? And so it's a lot more of a you eat what you kill type of environment, and some people like that, and a lot of people don't, right? One thing you got to realize, like I was talking to my friend who's been working in a hedge fund for like the last 10 years or so. I was curious, so I just asked him like, hey, so how much money are you making now any given year? And he's like, you know what, like it varies anywhere from 400K to $1 million. Now that sounds great. It's like, you're like, well, 400K and $1 million, I'd be happy either way because it's a lot of money. But in reality, if you really think about it, what typically happens is as you start to make more money, your lifestyle also increases with that, right? They call it lifestyle creep. And so if you've been expecting to make $1 million, because say you made $1 million last year, and you start buying bigger houses, driving more expensive cars, spending more money, sending your kids to private school, whatever it may be, and then all of a sudden the next year, your compensation drops down to 400K. Now all of a sudden you're not able to afford all these things. You can't make your car payments, you can't pay your mortgage, so it's problematic, right? And so when your pay fluctuates so much, it's not always a good thing, in my opinion. Like you have to probably be on the more conservative side in terms of how you spend your money. And then, hey, if you have a great year, everything's just, extra bonus on top, right? So anyway, that's the compensation side. I would say like the pay in VC and P is a lot more stable. It's in a much tighter range. And again, it just primarily comes down to the size of your fund, okay? Now, in terms of hours, I think the best hours are probably going to be in venture capital on average. You can probably be working 50, 60 hours or so. But, by the way, when I say 50, 60 hours, like that might be how much time you spend in the office. But in reality, what you need to understand is that in any of these buy-side jobs, very, very demanding, right? And just because you're not in the office, it doesn't mean that your mind is not thinking about work. Like you're always on, right? And in VC, even if you're not in the office, like you're always constantly trying to source deals. So you might be like going to networking events and trying to meet with new entrepreneurs and whatnot. And so just keep in mind that the absolute number of hours that you're working is not the only thing that you need to take into account, right? Same thing in private equity. I've seen survey data on this. Varies anywhere from like 55, I've even seen 50 hours before, depending on the firm, all the way up to like 80 hours on the high end. And again, this is an average week. But in reality, it's very lumpy, right? It's just like banking is driven by whether you're working on a deal or not. Like if you're working on a deal, you could be working more hours than that. You could be working 90, 100 hours a week. And then like when you're not working on deals, you might be working 40, 50 hours a week. And then in between, like it kind of averages out, right? The other thing that you got to realize about private equity is you say, well, 55 and 80, that's a huge difference. Yeah, it's a really big range. And the work-life balance in PE is not as uniform as it would be in banking, where in banking, if you work at Goldman Sachs or Morgan Stanley or JP Morgan or whatever other top-tier bank, your hours are going to be relatively similar. It's in a very, very tight range. But in PE, like that range can really vary depending on the culture of your firm, okay? And so you just gotta keep that in mind when you're recruiting. It's like, hey, if you have a strong preference for work-life balance, you want to make sure that you understand what the culture is like at the firm before you go. Like, is this a sweatshop type of environment, or is this more of a laid back, very, very chill type of environment? Okay. At a hedge fund, I would say probably between 50 to 70 hours, so slightly better than private equity. Although again, depending on the fund you're at, and you're working market hours because you're buying and selling stocks, so you got to do that when the markets are open. But again, in reality, it's like I know a lot of my friends that work in hedge funds. You're always on, right? You can never just completely shut down, even when you're not at work, like things are constantly happening in the markets. There's constantly news coming out, and you're gonna have this need to like always be on top of everything and know about things as soon as they happen. And so it's not like, oh, once you walk out of the office, you go home, you're just relaxing for the rest of the day and watching Netflix or something. That shouldn't really work like that, unless, like, especially if you're going to be a top performer, right? And like, I know friends that work at hedge funds are always reading the papers, always like consuming financial news and other content to like try to find any edge they can in the markets, right? So anyway, that's on the work-life balance front. Okay, exit opportunity wise, this is pretty straightforward. I'll start with hedge funds because that's the easiest one. If you go to a hedge fund, you're most likely going to stay in public investing. Okay, it's really hard to move from a hedge fund to outside of public investing because you just get really, really good at one thing and one thing only, which is like investing, right? Like picking stocks or bonds or whatever it is that you're trading, right? On the other hand, if you're in venture capital, you can either move up in VC, obviously, like, go on the partner track if you're good at it. You can go and get a top MBA if you want, typically, especially if you come from a good firm. Or you can exit to work at a tech startup, possibly even, one of your portfolio companies, right? So that's what I see a lot with people that start out in VC. In private equity, you probably have the most flexible exit opportunities out of the three because, yeah, you can stay in PE and move up there, but you can actually also move into VC. You can also move over to a hedge fund. You can also get a top MBA if you want. A lot of private equity firms are actually feeder programs into PE because, they just, like a lot of the senior partners, they have relationships at these business schools. Sometimes they even sit on the board. Also, like they're constantly sending their associates into these business schools every single year, right? So there's more of a relationship there than there would be, say, at a hedge fund. Because hedge funds don't really require their people to go back and get an MBA because you don't need a degree to be good at, trading, right? So top MBA is an option, and then like going corporate. But in this case, you're not just limited to technology startups like you would be in VC. You can go into Fortune 100 companies. You can go work in tech if you want to. That's a popular thing to do nowadays. That's what I did after PE. And so there's a lot more directions that you can go in. Why is that though, right? The reason that is though really comes down to this last bucket, which is what you're going to be learning on these jobs, right? And so I put here kind of the different things that you're going to learn. So there's a couple of different categories, right? There's sourcing deals. There's portfolio management, which means like working with your portfolio company. So that's kind of like more of the operational side of things. Learning how to run a business, helping the management team increase their revenue growth or increase their margin profile, become more profitable. There's deal process management, which means like, like when you're in banking, you do an M&A deal or you do an IPO deal, you have to manage a process, right? So there's a deal process. Same thing when you're in venture capital, there's a deal process. When you're in private equity, there's a deal process. So there's a lot of more like the administrative and logistical side, which is still really, really important, but you have to learn how to do, right? You don't have to do any of that at a hedge fund because you're just buying and selling stocks for the most part, right? So you don't have to do a lot of these things. And then, of course, there's also financial modeling, right? Financial modeling is like, 3 sigma modeling, LBO modeling, valuation, DCFs, whatever. That all counts, right? And so those are the kind of the different categories, and I kind of listed them here. And as you can see, at a hedge fund, your primary skill set is going to be financial modeling. And by the way, I should have also put due diligence along with that, but financial modeling and due diligence kind of go together because you have to do due diligence to come up with the inputs into your financial models, right? And so it's a singular skill set, and that's why it's hard to move from a hedge fund to some of these other roles that require these other skills that you now don't have, right? And so I think an easier way to visualize this, let's go to the next slide, is to use this Venn diagram, okay? And so what I drew here is, look, there's one skill set, which is financial modeling and due diligence, right? And then there's also deal process management, like I said. And then there's also sourcing and portfolio company management, okay? And I basically put PE, hedge fund, VC. I also added IB here just to show you like what you'll actually be learning in each of these jobs, right? Like if you start out in IB, you're going to be doing a lot of financial modeling and you're going to learn how to do due diligence. That's why IB is such a good stepping stone into all of these buy-side roles because you have these two skill sets, right? And so IB sits in the middle of these two, okay? If you're at a hedge fund, like I said, you do the financial modeling and due diligence. You don't do any of these other things. You don't do the green part. You don't do the red part, okay? If you're at a VC firm, because you're dealing with much earlier stage companies, you'll deal with sourcing, you'll work with your portfolio companies, you'll have to manage the deal processes, but it's not really heavy on the financial modeling, okay? Because there's not that much to model when you're working with early stage companies, okay? You pretty, like, even if you built a model, a lot of these companies don't have revenue yet, so it's like the numbers you're doing are just made up, right? Or even if they just started having revenue, if you try to build a model that's 5 years, 10 years out, a lot of things are going to change. So that's not really what VCs primarily base their investment thesis on. It's not the model, right? Now, if you're in PE, you kind of have to learn all three of these things. You gotta sometimes you gotta source deals, especially more so if you're in growth equity, because that's closer to a VC model. But depending on the firm, you're gonna have to source your own deals. You're gonna have to manage the portfolio companies that you've invested in. You're gonna have to manage the deal processes anytime you do a leverage buyout, or if you take your company public, or if there's a M&A deal involving your portfolio company, whether they're buying another company or you're selling them to another company, and so you get that skill set. And then there's heavy financial modeling involved because you're building really complex LBO models, three-statement models, so on and so forth, right? And so really, the thing that I personally really like the most about PE, I mean, yeah, the pay is great and all that, but really it's the fact that it sits in the middle of all three of these areas, and you really get to learn all of these different skill sets. And what that does is, again, to come back to this slide, it gives you the most exit opportunities, right? Like if you're not sure whether you're going to stay in PE forever, or if you're not sure if you're going to stay in hedge funds forever, or you're not sure if you're going to stay in VCs forever, then what's the smartest thing to do is to preserve as many options as possible so you can go in any number of directions, right? The other thing you have to realize when you go into the buy side, whether it's a PE or a hedge fund or a VC firm, is that there aren't that many jobs available, right? It's kind of like a pyramid structure, and the higher up you go, the fewer positions are available, right? And the senior people, like the partners at the top, there's not that much turnover, right? They stay in that role for a long time. And so a lot of people aren't able to just continue to progress up all the way to the top. And at some point, they might have to go off and do something else. So you have to think about, hey, if that happens to be you, and as you're climbing this ladder, you kind of stall out, are there other things that you'd be able to do, right? One of the common things that people will do is they might lateral to another similar fund, or they might move downstream a little bit to a slightly smaller fund and get promoted to a more senior position. But look, if that doesn't happen, or maybe you don't even want to stay in the buy side after a couple of years and you just want to go do something else completely, do you have the opportunity to do that? Are you going to be a desirable candidate with the relevant skill set for whatever it is that you may want to do, right? So from that perspective, again, I'm biased because this is how I came to the conclusion of going to PE as opposed to maybe VC or hedge fund when I first started, is that I wanted to sit in the middle of this diagram here, and I knew that, hey, even if I did 2 years of PE, if I decided I didn't want to stay in PE, let's say I changed my mind later, I want to go to a hedge fund, I have the skill set to do that. If I wanted to go downstream to VC, I had the skill set to do that, right? If I want to go back to investment banking, I can still do that. Like, I know people that have done that. It's rare, but it does happen, right? Or if I want to stay in PE, or ultimately what ended up happening was I ended up going to work with some tech companies, right? I worked at Square, I worked at GitHub, right? And so at the end of the day, again, to reiterate, all of these are phenomenal jobs. A lot of people will be dying to have these jobs. So if you can get any of these jobs, like, you should be super happy. But if you're in a position where you're still debating between one versus the other, and you're trying to figure out, like, hey, what are all the pros and cons? This is just kind of my take on things, and so take it for what it's worth. And hopefully you guys found this to be helpful, okay? And obviously, if you have any questions, feel free to reach out to me. I'm happy to give you just more insight on whatever it is that you want to know. All right? That'll be it for this video. Thanks, guys. Hey there, I hope you enjoyed this video. If you're looking for more customized advice that's tailored for your specific situation, then I invite you to book a free strategy session with our team at the link below. We'll talk to you soon.